Hello and welcome back to All Things Money. I'm David Blain, your host for today's show. And during this segment, we're going to continue our discussion on annuities, indexed annuities, variable annuities, fixed annuities. They're all different types of annuities. And we're discussing the sales methods that are used to sell these annuities and whether it's appropriate, whether this product is appropriate. I got a little saying about annuities, kind of like life insurance, and of course an annuity is a life insurance product. If you keep that in mind, maybe it will make you a little bit more skeptical. But these products are never bought, they're always sold. And by that I mean no one wakes up one day and says, gee, I wish I had an annuity. What they may wake up and say is, well, I'm a little bit nervous about the market. I didn't like the way I was invested the past few years. I lost some money. I wish there was some way to have some sort of guarantee or, more stable source of income. And lo and behold, the annuity salesperson shows up with the magical solution to solve all your problems. And so before the break, we were talking about this company, Jackson National, that has catapulted from somewhere number 8 in the market, all the way up to 3rd place next to MetLife and Prudential. You probably heard of MetLife and Prudential. You ever heard of Jackson National? Probably not. Anyway, so there are a lot of concerns about whether they're going to be able to meet the guarantees that they've been promising. And in fact, Prudential, who's the top variable annuity seller in January, reduced its compound growth on its annuities highest daily account to 5% from 6%. So these are, when you sign up for these annuities, they're guaranteeing something, and all the companies are saying, whoa, I think we've guaranteed too much, we need to start cutting back. And MetLife in February adjusted its calculations to reduce the income annuity customers receive when they activate their GMIB Plus income benefit rider. So all these companies are realizing that what they're promising is probably not achievable. And in order to understand what exactly you're guaranteed, each one of these comes with like a 3-inch perspective that you've got to be able to read and figure out. Last show I talked about how most annuity sales companies, they offer training, but most of the advisors don't even bother to take the training. And so one of the things on the other side, this guy David Provenzal, who does not sell annuities, says, it's evidence to me that both the industry and advisors continue to underestimate the long-term risks of these generous programs. And that is one big concern with the annuities. So, I could go on and on about the headlines out there. Here's one: fantasy world returns for equity index annuities. Index annuities are a safety trap. From CNN Money. What's wrong with variable annuities? Smart Money. And the list goes on and on. If you take the time to dig into it, I'm just trying to give you a little bit of a highlight here today. So let's get back into some of the specifics. That one of the benefits that's touted of the annuity is the death benefit, meaning that they will guarantee a certain amount of money. So, for example, if you put in $100,000 and you invest it and you die 5 years later, if your account value is not $100,000, they guarantee $100,000 to your heirs. Of course, you're dead. Didn't do you much good. My point with that is, if you need that death benefit, if you would like to leave something to your heirs, get a life insurance policy. Get a cheap term life insurance policy. Once again, don't mix the investment and the insurance. If you need insurance for insurance's sake, which is to protect the income if you're the primary breadwinner, or if you would like to leave a nest egg for somebody that you haven't been able to accumulate, by all means, get a reasonable term policy. But to mix the two, I think you'll find that the insurance component of the annuity is very, very expensive. A major problem of these annuities is the surrender fees. Once you sign on the dotted line, you are captive to the insurance company, and it's very difficult. Well, it's not difficult to get your money back. It's very expensive to get your money back. Most of them have at least a 7-year time frame where you have to pay penalties to get your own money back. And if you think about it, the reason is because on the front side, the insurance company paid out a huge 7% commission to the agent. So you've got to stay in that product for at least 7 to 10 years so the insurance company can recoup all the fees that they paid in commission to that advisor. That's the simple reason why they have the surrender fees, is because they pay it all up front to the guy that sold it to you, and they need to recoup their fees. Which leads us to the second point, is that the ongoing fees in annuities are very expensive. And once you sign on the dotted line, they're going to make their money one way or the other. Either you say, oh, I made a mistake, and you want to get out, you're going to pay the surrender fee. But if you stay in, you're going to pay a tremendous amount of fees on an annualized basis. You've got the mortality expense fee, which is usually an inflated cost of insurance. You've got administrative fees. You've got income riders. You've got death benefit riders. And of course you have the underlying sub-account fees, sort of like a mutual fund fee. When you invest in an annuity, they turn around and give the money to some money management firm who charges another fee. So it's very common to see the fees on these things run up easily well above 2%. I saw one time a client came into me, and when we added up all the sub-account fees, the rider fees, and everything, they were paying right about 4% per year in fees. There's no way in the world, I don't care what kind of guarantees you have on that thing, there's no way in the world you're ever going to get ahead with that type of product. Well, as we wind down today's show, we are just scratching the surface on these annuities. My plea to you out there, if you're listening, is if you're considering one of these or if you own one, don't take my word for it. Is go out there and get some independent research, someone that's not a life insurance agent, someone that does not sell these products, someone that is not an insurance company. And I think you will find that there are many drawbacks to these products, and that for most people, it's best just to stay away. Now, we'll probably, depending on what type of comments we get during the week and what questions, we may continue with this topic again next week, because there's a lot more of this that I would like to cover. But for today's show, that's about all the time that we have. So for All Things Money, I'm David Blain, and we hope to see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.